Hey, hi guys. So as promised, this is tutorial for chapter 10. So I'm going to start with Vixen Co. And then I will do the sensitivity analysis of Warden Co. Here you can see we have part C. Just going to erase this. It's a bit messy. Okay, we have part C, which relates to sensitivity analysis. And if we have enough time, we will do one theory question. Okay. So, Vixen Co. What is Vixen Co talking about? How do we do this question? So, number one, he asks you to discuss the difference between risk and uncertainty. Okay, guys, this is rather simple and straightforward because all you need to do is you need to tell him risk arises due to past events. Okay. It can be quantified, and how you do it is you use expected value analysis, while uncertainty, no past event to indicate no past events to indicate it actually happens, can be described and not quantified. How you do it is you use the payback period, adjusted payback period, and also sensitivity analysis. Okay, enough. Okay, you don't need to write too much or too long because examiner only gave you 3 marks for this, so you don't want to unnecessarily explain things that he doesn't want to know or he doesn't want to see. Now the next one, calculate the expected net present value. So guys, remember when I said that he got expected net present value, what is it that he will definitely have? He will definitely incorporate probabilities. Okay, and then you need to comment on the financial acceptability and on the risk relating to variable costs. Okay, so let's talk about first this question. Let's do the NPV first. Okay, now Wixon is evaluating a planned investment in producing a new equipment costing 20 million. So this is initial investment. This is payable at the start of first year of operations. So beginning of first year also equals to end of year 0. And then the product will be produced for 4 years. Okay, so 4 years. This is the useful life, all right? At the end of which production will cease. The investment project will have a terminal value of 0. So guys, what is terminal value? Terminal value is actually your scrap value. So your scrap value is equal to 0. Why do they use the word or the term terminal value? Because terminal value actually means the value at the end of the project. That means after 4 years, the value at the end is equals to 0. So when this value equals to 0, it also means that the project's scrap value will be 0. Then he gave you financial information. The financial information that he gave you is sales volume, selling price, and fixed cost. So the sales volume that was sold is 440,000, 550,000, 720,000, and 400,000. Your selling price per unit that was given to you 26.5, 28.5, 30, and 26. Now he has given you also the information relating to fixed costs. So the selling price have not yet been adjusted for inflation, which is expected to be 3.5% a year. So here the inflation is 3.5%. The annual fixed costs are given in nominal terms. So examiner has actually given you the fixed cost value in the nominal terms. That means he has already included time value of money or inflation. Okay, now variable cost per unit depends on whether competition is maintained between suppliers of key components. The purchasing department has made the following forecast, so probability and the variable cost per unit. Variable costs in this forecast are before taking account of variable cost inflation of 4% per year. So here, your variable cost inflation is 4%. Now, guys, once you see an information like this, what I want you to do is I want you to calculate the expected value directly. Okay, whenever you see a calculation like this, it means that your calculation includes the expected value. Now, Wixon can claim tax allowable depreciation on 25% reducing balance basis for the full investment cost of 20 million. You pay tax of 28%, 1 year in arrears. It is planned to finance the investment project with an issue of 8% loan notes redeemable in 10 years' time. Wixon has a nominal after-tax WACC of 10% and a real cost of capital of 7% and a cost of equity for 11%. Guys, he has given you so many discount factors. Now, if you were the person to decide which one you use, which discount factor would you have used? If it were you to decide on the discount factor to use, which discount factor would you have used? Because there are so many, right? Okay, so you should ideally choose nominal after tax weighted average cost of capital. Okay, this is the value or this is the amount that you should percentage that you should use. Okay, so now let's talk about this. Okay, let's do this question in Excel. Okay, together we will do it together now. Okay, since we have information, so this is sorry, x y. Guys, I don't remember how to spell it. Vy x y n. Okay, sorry, Vy x y n. Okay, now when you do this, okay, step number one is to calculate the expected NPV. So year, okay, sales, variable cost, fixed cost, operating cash flow, tax at 30%, initial investment, scrap value, tax saving on capital allowance, net cash flow, discount factor at 10%, at 10%, PV and PV. Okay, guys, now remember when you do this, leave a column first to write your working, and then 0, 1, 2, 3, 4, and one additional column to write your text for your text. Okay, Okay, I'm going to go a bit fast here because I'm going to expect you to be able to answer the question more appropriately. Um, Sorry, not more appropriately, faster than what you have been doing. Okay. So for your sales, okay, the first thing that you need to remember, you need to inflate your cost. So equals to 26.5 multiply 1.04. Okay, and the sales volume is 440. Give me a moment. Okay, number two, 28.5 multiply 1.04 to the power of 2 multiplied by 550 units. Okay, I'm going doing it all in thousands, so I only take the 550. The next one, 30 multiply 1.04 to the power of 3 multiplied by 720, and year 4 will be 26 multiply 1.04 multiply by, sorry, to the power of 4 multiply by 3 400, sorry, not 300, 400. Okay, now variable cost, you must do working number 1 because you need to first calculate what is the expected variable cost. I'm going to leave a few lines. Workings number 1, expected variable cost. So your expected variable cost equals to, okay, 45% multiply 10.8, 0.45 multiply 10.80 plus 35% multiplied by 12 plus 20% multiplied by 14.7. So your expected variable cost is $12 per unit. So equals to okay. So equals to okay, let me go back to check the question. 4%. Oh no, guys. You need to change the inflation rate to 3.5%. It's not 4%. The 4% was, sorry, my bad. It was for um variable costs. Okay. Okay, so this equals to 12 multiply 1.04 multiply 440 equals to 12 multiply 1.04 to the power of 2 multiply by, okay, I don't remember what is the number of units, 550 equals to negative 12 multiply 1.04 to the power of 3 multiplied by number of units, which is 720, and finally 12 multiply 1.04 to the power of 4 multiplied by 400 units. Okay. Fixed cost was already given in the question. The amount of fixed cost is negative 1100, negative 1121, negative 1155, and negative 1200. Okay. So my operating cash flow Now remember, when I told you to do this is 0. Always when one year in areas, you always put 0 equals to negative this, multiply 0.3. Let me double check if it's 30%. No, it's 28%. Okay, 28%. So you can change this. So make sure your brain doesn't work on default. Copy, paste, right? Your initial investment, I remember it was 20 million. Okay. Scrap value is 0. Tax saving on capital allowance, working number 2. TSCA, year, cash flow, tax at 28%, timing, year 0, 20 million. Year 1 is at a 25% reducing balance basis. Add together. So guys, remember what I told you? You copy, you paste for year 2 and year 3, then you label it first. Okay. So you label this. Okay. Then you minus scrap value, in this case is 0. So your year 4 will be this. Your tax equals to negative this, multiply 0.28. Copy, paste, paste. Okay. So your timing 2, 3, 4, and 5. So you will go here, and then in year 1, please put the 0. I don't want you to make an unnecessary careless mistake. Okay. This topic is very easy to make a careless mistake. You want to try to avoid it as much as you can. Even you can see that me, despite me teaching for so many years, I still have the tendency to make unnecessary careless mistake. So if I can do so, why not you? Okay, now calculate your net cash flow sum from operating cash flow onwards. My discount factor, let me double check, 10%. Okay. It's always good to double check so that you don't make a random careless mistake unnecessarily. Okay. Okay, use the same concept that I taught you. PV equals to okay, now guys, you can see your expected net present value is a positive value. So your expected NPV positive, that means your project can be accepted. It is financially viable. The project will be accepted. Hence finance, not NPE, yeah, NPV. Hence financially viable. So with this, I think you guys can know that it's quite easy. The only difference is this is literally the only difference. The others are exactly the same as an NPV question. Don't worry, I have a few more questions that I want to do to you with you. So the next question that we will do is Warden Home. Okay, so yeah, Warden Home. So we will read the question together. part C, and then we will start with the question. Okay, here. He asks you to explain briefly the meaning of the term sensitivity analysis in the context of investment appraisal. So guys, you need to understand that when he says sensitivity in the context of investment appraisal, that means here what you are doing is you are calculating the variable that will affect the NPV in such a way it will become 0. Okay, make sure you write it in full sentences. Now, he's only giving you 1 mark, so don't waste time. You will definitely get 1 mark here. Okay, now he asks you to calculate the sensitivity of the investment in the new machine to a changes in selling price and a changes in discount rate, and he asks you to comment on your findings. Now, so the sensitivity analysis that he's asking you to calculate is selling price and discount rate. So guys, for Warden Co, the first thing that you need to know is what is the NPV. So we have already done this question together. The NPV of Warden Co is 103,000 if I'm not mistaken. Let me just double check. Yes, 103, that's right. Okay, so this one we have done it together. This one is 103. It's positive now, not negative. Okay, now let's proceed to calculate your discount, sorry, sensitivity analysis. So here, Warden Co. Okay, so this one. Sensitivity analysis. Okay, guys. So the first one, he asks you to calculate. So always remember, step one, start with NPV over PV of cash flow. My cash flow is your selling price. Okay. Now, what you need to do is, for the purpose of this question, you need to find what is your present value of sales revenue. So you must do it after tax. Now you must be careful because your tax is put in arrears. So how to calculate here? Discount factor in this question is 11%. PV of cash flow. Okay, so from year 1 to year 5, your revenue was 1,600. Okay, your 11% annuity factor, I will show you in a while how to do it. Now from year 2 to year 6, okay, so year 2 to year 6, this one I said 5 but I wrote 6, right, is equals to negative multiply 0. Tax in this question is 30%. Okay, now how do I do the discount factor? You can just copy paste from the question the annuity factor, or what you can do is you can calculate it by yourself. I'm going to copy paste from the annuity table. Okay, 11%, 5 years, 11%, 6 years. Okay, so my present value of cash flow. So maybe I write here cash flow because PV of cash flow is different. Okay, PV of cash flow is equals to this multiplied this. Oh, guys, because I didn't write down the figure, 3.696, 4.231. Okay, copy paste. Okay, then total up everything. This is my present value of cash flow. So NP was 103. My present value of cash flow is here. So your sensitivity analysis your sensitivity analysis percentage will be equals to this over this, which is 3%. Okay, now for sensitivity of discount factor, okay, your discount factor is equals to 11%. Now you need to calculate the IRR first. So guys, I'm just going to give you the value. If you calculate IRR, you should get 16%. Okay. Now to calculate sensitivity of discount factor is the percentage of change where your NPV will become zero, correct? So here, when you calculate IRR, this is the percentage where NPV is equals to zero, correct? So the logic is I want to see the discount factor has to change to the IRR before NPV equals to zero. So what is this percentage? Okay. What is this percentage of change? Okay. So this percentage of change is this discount factor has to reduce, your discount factor have to increase to your IRR. Okay, in your brackets, okay, before it becomes zero. So the percentage of change, I don't know why it became like this. Okay, the percentage of change should be 45%. So the discount factor will need to change by 45% before your NPV becomes to zero. So guys, remember I told you just now, there are three methods. Number one, sensitivity of cash flow. Number two, sensitivity of sales volume. And number three, sensitivity of discount factor. So we have already learned this. I've taught you this. This is exactly the same of cash flow. The only difference is for sales volume, we will use contribution. And now sensitivity of discount factor, I'm doing it here. So please make sure you know how to calculate all three because examiner can ask you, especially when he thinks that students are not so well versed with this. Students are not so good in the calculation. He will purposely do this to ensure that he can test your knowledge. Now, I haven't commented yet. You can see that between your selling price and your discount factor, the most sensitive variable is your selling price. So between and discount factor, the more sensitive variable is the selling price with the SA of 3%. Okay, so what it means is that the management will have to pay more attention on the selling price, as it is likely the factor that will lead to NPV becoming zero. Okay. So this is actually simple and straightforward. There isn't anything more that is difficult here. Of course, if you want to comment more, you can go ahead and do so. But I always tell you, do not write too much, because writing too much doesn't mean you will get more marks. Writing too much might only mean that you may write unnecessary information and you may also waste time. So when you write a question like this, please just be aware of how much you are writing and what are you writing. Your examiner doesn't want the grandmother, grandfather stories and all that. He wants only the relevant information, only the information that is required by you guys. Okay. He doesn't want anything more than that. So whenever he asks you a question like this, please be aware of what is he asking and don't write unnecessarily. Okay. Let's move to the next part.